When it comes to investing like Warren Buffett, it is much easier to see than it is to do. Warren Buffett is widely regarded as one of the most successful investors in the Chronicles of Financial History throughout the world. This assertion is supported by his staggeringly large net worth. But what many people don't realize is that in order to achieve success, he had to put in a lot of effort, which the average person cannot easily replicate. Warren Buffett, widely regarded as one of the world's most successful and well-known investors, has amassed a net worth of more than $102.2 billion as a result of his diverse investments in industries such as energy, retail, and finance. This is because he has tested his investments in a wide range of companies. According to a quote attributed to Buffett, it is preferable to buy a spectacular company at a fair price rather than a fair company at a fantastic price. But what is his stance on this? Make certain that industries in which you invest your money are ones in which you have a thorough understanding of the market. If you believe this will be too difficult, you should consider investing with someone who already knows how to achieve this goal. He recommends starting early and avoiding putting all of your eggs in one basket when developing your strategy. When asked about risk, he stated that something is not truly dangerous if you believe it is likely to occur, but don't know when or why it might occur. When it comes to making decisions, Buffett does not make rash decisions. Rather, he carefully considers all of his options before deciding to pursue one specific investment opportunity. This is another valuable lesson from Buffett that we can apply to our own lives. How difficult is it to invest like Warren Buffett? And what are some of the factors that make it so difficult to manage and expand its fortune? Warren Buffett, widely regarded as the world's most successful investor, takes a fairly straightforward approach. He selects companies to invest in based on the strength of their business ideas, the level of risk they pose, the consistency of their profitability, and the current market prices. In other words, he only invests his money and believes that he is completely familiar and understands before doing so. Putting this into action, on the other hand, may prove difficult. Market knowledge and a thorough understanding of the asset class in which you are investing are the most important requirements for successful investing. Second, you must identify companies that meet your criteria and be able to purchase their stocks at a reasonable price, so that they can generate both capital gains and dividend income for you. When the stock market is volatile, you must maintain a level head and be patient rather than allowing your emotions to take over. Third, in order for the business to grow in a sustainable way over time, you must ensure that the company's management team continues to respect the company's beliefs. Last but not least, you will need personal access to Warren Buffett. As a result, having access to Buffett, who monitors the global economy through Berkshire Hathaway, is critical. The dangers of a rosy financial market outlook. When it comes to making financial investments, there are a number of pitfalls that people must be aware of in order to avoid them and ensure that they do not lose money. One avoidable trap is the belief that someone will be successful in investing simply because they have been successful in other areas of their life. This is just one of the many traps that exist. This statement could not be further from the truth. When someone who has never invested before looks at all of the success stories, this is a complete and utter fabrication. It is easy for them to believe that if they invest in the same way as others who have succeeded, they will also succeed, because they have followed in the footsteps of those who have succeeded. The truth is that these investors may have been more fortunate than skilled as a result of the unusual circumstances in which they found themselves. This is the conclusion that can be drawn from the information presented here, because even the most astute investor understands that any investment can result in a capital loss. As a result, they will be less likely to expose themselves to excessive risk by not diversifying their holdings. This is due to the fact that any investment can result in a capital loss. When you diversify your holdings, you spread the money you have available across a variety of industries and businesses. As a result, you must be concerned about suffering significant financial losses, even if the performance of a single sector is poor, and you should think twice before following in his footsteps. Warren Buffett is widely regarded as one of the world's most successful investors. He is well known for his astute investment strategies. Before you go out and buy stocks, you should be aware of a few aspects of Warren Buffett's investment philosophy and process. Number 1, he always keeps the big picture in mind. When it comes to stocks or other financial instruments, many people have a more short-term perspective when it comes to investing. He sees things from a more distant perspective. They want to make as much money as possible in the shortest amount of time possible, so they can move on to the next opportunity. This is not what Buffett does for his company when deciding whether or not to make an investment. He doesn't even consider the short-term fluctuations in stock prices. This could be because he doesn't think they're important. He is looking for a company that has a competitive advantage over its competitors that can be sustained over time and will allow the company to retain its value. Number 2, rather than investing in individual stocks, he prefers to invest in entire businesses. Several investors would argue that even though Berkshire Hathaway owns many different companies, purchasing shares of individual companies through Berkshire Hathaway is still the same as putting all of your eggs in one basket. Buffett, on the other hand, avoids this trap by investing in entire businesses. When you buy Berkshire Hathaway stock, you get the entire company in addition to everything else that comes with the purchase. This is due to the fact that the shares include everything else included in the purchase. As a result, you'll be able to weather any storms that come your way and make the most of the good times that come your way. If you take the bigger picture approach, it also means that if something goes wrong with one part of your investment portfolio, such as a specific industry or security, you'll have plenty of other parts, companies, and securities working in tandem to make up for any potential losses. This is due to the fact that looking at the bigger picture allows you to consider the interconnected nature of your investments. This is because the strategy focuses on the big picture rather than the individual components of the portfolio. In conclusion, Warren Buffett's remarkable level of financial success is due in large part to the shrewd and trustworthy method of investment that he employs. But it is also due in large part to the overall philosophy that he adheres to each of these. Concepts exemplifies Warren Buffett's fundamental approach to investing, which can be summarized in 2 words: patience and logic. Buffett is widely regarded as one of the most successful investors of all time. Furthermore, each of these guiding principles provides support and authority to the other ideas. For more videos like these, please like the video and subscribe to the channel.